There's a word that nobody in Washington wants to say out loud right now. Not the economists on TV, not the banks, not the headlines. But you've probably felt it already. At the grocery store, at the gas pump, in that moment you checked your account balance and quietly closed the app. The word is recession. And here's the thing nobody is telling you. We might already be in one. Not the official kind, not the kind that gets declared with a press conference and a red graph on CNN. The quiet kind, the kind that doesn't show up in the data until it's already eaten 6 months of your financial life. My name is Jack, and today we're going to do something that the financial media is too nervous to do. We're going to look at what is actually happening to real American households right now, the numbers, the patterns, the warning signs, and figure out what it means for your money before the official announcement ever comes. Because by the time they call it a recession, the people who weren't paying attention have already lost a year of ground. Don't be that person. Stay with me. First, let's talk about what a recession actually is, because the definition itself is part of the problem. The official definition is 2 consecutive quarters of negative GDP growth. That's it. That's the whole rule. Which sounds simple until you realize GDP is a number that measures the entire economy, trillions of dollars of corporate activity, government spending, exports, and it can stay positive while millions of regular households are quietly drowning. GDP doesn't care that your grocery bill is up $400 a month. GDP doesn't care that your rent just jumped $300 and your landlord called it a minor adjustment. GDP doesn't care that you put the car repair on a credit card because the savings account wasn't an option anymore. The economy can be technically growing while your personal economy is shrinking every single month. That gap between the official number and your actual life is exactly what we're talking about today. And right now, in 2026, that gap is wider than it's been in years. Let's go through exactly what's happening right now. Not opinions, numbers. Sign number 1. Consumer debt just hit a record. U.S. consumers collectively owe $18.33 trillion in total debt as of mid-2025. The average American household is carrying $104,755 in debt. That's not a mortgage only. That's credit cards, auto loans, student loans, personal loans, all of it stacked on top of each other. And here's the part that should bother you. Credit card delinquencies, people who are 90 days or more behind, have now climbed above pre-pandemic levels. More Americans are falling behind on their bills today than almost at any point in the last decade. That's not a sign of a healthy economy. That's the sign of an economy where people borrowed money just to stay in place, and now the bill is coming due. Sign number 2. Is a recession coming? Just spiked 5,000% on Google. Think about what that means for a second. When people are genuinely comfortable about their financial lives, they don't Google recession. They Google vacation spots, new cars, home renovations. But when 5,000% more people than usual start searching whether a recession is coming, that's not curiosity. That's fear looking for confirmation. And people searching that question in huge numbers is itself one of the most reliable leading indicators economists use, because consumer confidence drives consumer spending, and consumer spending is 70% of the entire US economy. When people get scared, they stop spending. When they stop spending, the economy contracts. The Google search is the early warning signal. Sign number 3, the affordability crisis is getting worse, not better. In March 2026, inflation came in at 3.3%, still above the Fed's 2% target. Tariffs on imported goods, cars, furniture, appliances, electronics, are pushing prices higher at the exact moment wages are struggling to keep up. Housing, mortgage rates are still elevated, and tariffs on construction materials could mean 450,000 fewer new homes built through 2030. Less supply, same demand, prices don't fall, they stay painful. The cost of being alive in America in 2026 is genuinely, measurably higher than it was 2 years ago, and the raises most people got didn't cover it. Sign number 5. Nearly 30% of Americans can't cover a $500 emergency. Not 5,000, 500. The Federal Reserve found that nearly 30% of American adults could not handle a surprise $500 expense using cash or savings. Around the same percentage couldn't cover 3 months of expenses by any means at all. That is not a stat of a recession. That is the stat of a country where millions of people are one Tuesday away from a financial crisis, and they're living that way right now in what is technically still a growing economy. Sign number 5. The middle class is quietly disappearing. In 1971, 61% of Americans were considered middle class. Today, that number is 51%. A full 10 percentage points of what used to be the stable, reliable middle of this country has been squeezed out over 5 decades, and the pressure isn't letting up, it's accelerating. The shrinking isn't dramatic, it's quiet. It's a raise that doesn't quite cover the new insurance premium. It's a promotion that moves you into a higher tax bracket but doesn't actually change what you can afford. It's the gap between what life is supposed to cost and what it actually costs growing 1 year at a time, until one day you do the math and realize the numbers stopped working. That's 5 signs, all happening simultaneously, right now. None of them require a press conference to be real.
So if all of this is happening, why isn't anyone saying it? 3 reasons, and none of them are good. Reason 1, saying the word makes it worse. This isn't paranoia, it's psychology. The moment a major institution, a bank, the Fed, the White House, officially uses the word recession, consumer confidence craters. People stop spending, businesses stop hiring, investors pull back. Calling a recession can actually trigger a deeper recession, so nobody wants to be the one who says it first. Reason 2, the official numbers lag reality by months. GDP data gets revised, employment figures get adjusted, inflation reports reflect what happened 2 months ago, not what's happening at your grocery store right now. By the time the official data catches up to what real people are experiencing, the painful part is often already over or already much worse than anyone said. Reason 3, the people measuring the economy aren't living the economy. This one's uncomfortable, but true. The economists, the analysts, the government officials measuring whether the economy is healthy, most of them have the kind of income where a 3.3% inflation rate is annoying, not devastating. For a household making $200,000 a year, higher grocery prices are frustrating. For a household making $55,000 a year, higher grocery prices means something comes off the list. The people deciding whether we're in a recession often can't feel the recession, and the people who can feel it don't get a vote on what it's called. Okay, quick gut check before we go further. Think about your own last 3 months. Has anything gotten harder? Not catastrophically harder, just quietly, persistently harder. The trip you didn't take, the restaurant you skipped, the "I'll deal with it later" moment when the bill came in higher than expected. If you nodded at any of those, you're already feeling what the data is describing. Now here's the part that actually matters, because knowing we might be in a quiet recession is only useful if it changes something you do. So let me show you the 3 types of people who come out the other side of a recession in completely different financial positions. And what separates them isn't income, it isn't luck, it's one decision they made before the official announcement. Every recession, quiet or official, sorts people into 3 groups. Group 1, the surprised. These are the people who weren't paying attention. Their debt was high, their savings were low, their lifestyle was built on the assumption that things would stay the same or get better. When the recession hits officially, or when their own personal recession hits first, they're caught flat-footed. Job loss becomes a crisis instead of a setback. A slow month becomes a missed payment. A missed payment becomes a collection call. The surprised don't fail because they're bad with money. They fail because they had no buffer. And in an economy running this hot on borrowed time, no buffer is the most dangerous place to be. Group 2, the surviving. These are the people who felt something coming, made a few adjustments, but didn't go far enough. They cut back a little, built a small cushion, kept their head down and hoped things would stabilize. They usually get through it, but they don't come out ahead. They come out tired, having spent the recession in pure defense mode, just trying to not lose ground and mostly succeeding. Group 3, the positioned. This is the smallest group and the least talked about. These are the people who, before the official announcement, looked at the same signals you're looking at right now, the debt levels, the search trends, the affordability squeeze, and made a few specific, quiet moves. They didn't panic, they didn't sell everything, they didn't move to a bunker, they just positioned. And when the recession officially landed, they were the people with cash ready to buy assets at lower prices, the people who got the promotion because they were the employee with no financial desperation and total negotiating calm, the people who came out of a down period with a higher net worth than they went in with. And here's the thing. The gap between Group 2 and Group 3 is not a gap in income or intelligence, it's a gap in timing. Group 3 moved first, before the press conference, before the headlines, before everyone else figured it out. That's why you're still watching this video. And here's exactly what moving first looks like.
I'm not going to give you a list of 47 tips. Nobody remembers tip number 23. 3 moves, that's it, in order of importance. Move 1, build the cushion before you need it. The research is brutal on this. People who enter a recession with 3 to 6 months of expenses saved recover an average of 2 years faster than people who don't. 2 years. That's the difference between the recession being a bad chapter and the recession being the chapter that changes everything. If you have less than 1 month of expenses saved right now, this is the only move that matters until you fix it. Everything else is secondary. Cut the subscriptions, cook more, drive less, do whatever it takes to get that number above 1 month, then 3. Because when the official recession hits, and it either will or this quiet version will keep grinding, the cushion is the entire game. Move 2. Don't touch your investments. Add to them if you can. Every recession in American history has ended. Every single one. And the people who kept investing, or better, increased their contributions during the down periods, came out dramatically ahead of the people who stopped or sold. The S&P 500, after every major downturn in the last century, has not just recovered, it's gone higher. The people who panicked and sold locked in their losses. The people who stayed boring and consistent built generational wealth during the periods that scared everyone else away. Recessions aren't when the stock market punishes you, they're when the stock market goes on sale, and most people are too scared to shop. Move 3. Make yourself harder to cut. In a recession, companies cut costs, and the most common cost they cut is people. But not all people equally. The people who get cut first are the ones who are easy to cut. Unclear value, replaceable skills, low visibility at the decision-making level. The people who survive layoffs and even get promoted during recessions are the ones who made themselves genuinely hard to replace before the cut started. That means one thing. In the next 90 days, make sure the people above you know exactly what you do and why it matters. Take on the project nobody else wants. Document your impact in numbers, not descriptions. Not because you're scared, because you're positioned. Here's the honest truth I want to leave you with. I don't know if this becomes an official recession in 2026. Nobody does. The economists will argue about it for years after the fact. But here's what I do know. The households that will look back on 2026 and say, that was actually when things turned around for us, they're not waiting for the press conference. They're the ones who looked at the grocery bill, looked at the debt numbers, looked at the Google search spike, looked at this video, and made one quiet decision to stop pretending the signals weren't there. You don't need a government announcement to start building your cushion. You don't need a recession declaration to stop adding to your debt. You don't need a headline to make yourself harder to cut. The official recession, if it comes, will be the moment everyone else wakes up. Your job is to already be dressed by then. I'm Jack, and if this changed how you're thinking about the next 6 months of your financial life, hit subscribe because the next video breaks down exactly how to build that 3-month cushion faster than you think, even on an average salary, even with debt. I'll see you in that one.